So we've talked about previously your financial foundation consists of investing in your skills, your emergency fund, your emergency preparation fund, and contributing to your wealth foundation. Last time we talked about your wealth foundation, how you're building up a fund that can support you when you have no other income at some point in your life. And I want to dive a little deeper into what that looks like. So, especially for those on the younger side, why it's important to do something early on in life. For those of us who are older, it's a little bit more of a lift, but regardless of where you are, it's a good idea to be putting aside money, first off. And if you're knowledgeable on investments, to also be investing. Don't invest in anything you don't understand, but that doesn't mean don't try to understand so you can start investing. So let me paint a little bit of a picture here. If you're in your early 20s, every dollar you invest can turn into over $70 when you are at retirement age. So 70 times what it was before. So that's quite a jump. More impressively, and I was just looking for this number and I'm not finding it, but the amount of passive income from your investments, for every $100 you invest now at 20 is something like $70 a month. Not $70 a month that you could have in income. So the idea is there's a powerful multiplying effect, and it can not only provide wealth, but it can provide cash flow, which is kind of what you want in retirement, is money coming in without you having to do anything. The younger you start, the more powerful each dollar is that you invest. So starting in, let's say that you get your first job at 16 and you start putting money into a Roth IRA, fantastic. You have a huge potentially huge tax-free money that you could have if you start that early. But regardless, even if you can't start till you're in your 30s, in your 40s, or even in your 50s, possibly even your 60s, depending on when you want to retire. That is if you can invest for at least 10 years, it'll be worth it to put money into the investments. Anything less than 10 years, it's not worth investing, because when you pull it out, it could be worth less. There's some volatility here. So the idea is that if it's less than 10 years, you do something like a CD, certificate of deposit, where you say, okay, I'm going to put it in, I got a guaranteed return, lock it in for a certain period of time. If it's 10 years or more, then consider investing. Get to understand investing before you do, but consider investing. So I threw out Roth IRA before. There are generally three categories of, if you're doing market-based investing, three categories of investing that you can do. One of them is a traditional just brokerage account. So you can put money, you just open up like an E-Trade account and buy some stocks, some ETFs, whatever, and you buy it in there. And the difference between the three types of investment accounts are how they're taxed. So if you buy things in a taxable brokerage account and you hold it for a period of time, like a year or two, then the profit, not the entire amount you sell, but just the profit of what you sell. So let's say you bought a stock at $100 and you held it for 10 years and became $200. So you'll be taxed on that $100 gain, not the original $100, but the $100 gain that you get when you sell it. So as soon as you sell it, you get a tax event and you're taxed on whatever gain you had. There's some things with losses, but we won't go into that. And that's called capital gains tax if you hold it long enough. Capital gains tax is very favorable. If your income plus your capital gains is less than $98,000, if you're married filing joint, you may not owe any taxes on it at all. Now, if you sell it before then, before it becomes long-term capital gains. Then it becomes regular income. The profit is just regular income. It's added on to your income and taxed at whatever your income rate is, whatever the highest bracket you're at, that's what it starts getting taxed at. So holding investments long-term capital gains is generally a good idea. So in addition to that, so that's one way, is you could just get a regular taxable brokerage account, buy your equities in there, sell them in there, cash it out whenever, and you're taxed when you sell and on the gain, right? Well, people who have higher incomes are like, well, but I'm getting taxed on that income before I even can put it in that account. I'd like to not be taxed on that. So that's where traditional retirement accounts come in, is you're not taxed. It reduces your taxable income right now. That means that the money you make, you're actually reducing how much is taxed. And then that money gets put into this investment, and then it grows without being taxed. You can buy and sell in that account. That's a traditional IRA, for instance. Traditional 401k is similar. And so you're not taxed. So I can buy and sell and do all sorts of things in that account. Nothing is taxed till I take it out. And different rules for when you can take it out. You're kind of limited on when you can take it out. Once you start taking out, generally 59 and a half, then anything you take out becomes income. Like, well, why would I want to not be taxed as income now, but be taxed as income later? Especially when I could have put it in a taxable account and it has much more favorable long-term capital gains tax than income would. The idea is that you reduce your tax burden now, and then in the future, when you pull it out, your tax brackets will be lower and you'll be paying less. So whether that's true or not, whether the tax brackets will be lower back by then, or whether your income will be low enough that it will be lower, those are all potential future things. We don't know. But the downside is that it does turn a little bit of taxable income, especially if you're in your 20s and you're investing, then that can become a huge amount of growth. So let's say you over time, or from 20 to 65, you invest, say, $1 million. But that $1 million could have grown to 5, 10, $20 million. So the compounding effect on that makes it so that the amount that you actually have in there can be much more than how much you put in. Not just double, more than double, much more than double. And so what you would have been taxed on, you reduce that little bit you would have been taxed on. So and you'll be taxed on all the growth as regular income. So that's where it gets to be, you have to be careful with that one. Especially because one of the things government does is they want their tax money back. So they have something called required minimum distributions. They will force you at a certain age in your 70s to start pulling out a certain amount to make sure that you drain that account before you die, so that they can get their tax money before you die. And it doesn't get passed on to generations. And anyway, so we had a regular brokerage account. It's favorable taxes, especially for, it can be favorable tax if it's held long term. Then you have the traditional retirement accounts, traditional 401k, traditional IRA, where it's not, it reduces your tax now and postpones it for later, including the growth of your investments. And then there's the Roth. You can have Roth 401k, Roth IRA. And the idea there is your income is taxed. So it's kind of like a regular brokerage account. You're going to be taxed on your income. It's not going to change your income tax at all. But once it's put in there, the growth will never be taxed again. So this is kind of like, this is like a taxable brokerage account in that you pay after you've already paid taxes, but there's no such thing as capital gains tax on it. There is zero tax on what you pull out of that account. You do have to wait until you're 59 and a half. There are other rules in there, but you could access some of it sooner. But the idea is that it grows. So people tell me, well, should I invest in, I'm starting my job, I'm getting a 401k, and they give me the option, a traditional or a Roth. Which one should I do? Each person's going to have their own situation. I'm not a tax professional. Definitely look into it. But for a lot of people, when they're very young, they're in a lower, one of the lowest tax brackets they're going to be, or one of the lower tax brackets. Sorry, if you're single, young, you'll be on a bit higher tax bracket, but your income is fairly low, so it's going to grow over time. So the idea is that, well, if you do a Roth now, yeah, you'll pay the taxes now, but that growth from the age of 20, 25, 30, 35, 40, the growth from then until when you start pulling out will be so much that it doesn't matter how much tax you paid on it. The growth is going to be amazing. Then as you get into your later years, when you're starting to be much more concerned about the taxes because your income has grown so much from the skills you developed over your career, that now the tax brackets you're getting up into, it'd be really helpful to remove some income from those tax brackets. And that's where it would be more beneficial, actually, because there won't be as much growth because you're closer to retirement. It's not as much time to grow it. And two, you have much more income being taxed at a higher rate that you can remove from that taxable bracket. And so a strategy is to contribute to a Roth through most of your career. And then as you get towards the end, start evaluating how much you have in traditional funds. Now, people say, well, if I did just Roth, that's all I'd have. Often an employer will give you a match. So they say, all right, you put in 4% of your income, we'll match it and put another 4% of your income in there. The match is often a traditional retirement account. And if you get a match starting at age 20, that match could have grown to the point where you're probably going to have higher required minimum distributions in your 70s than you were wanting. So that's something to keep in mind, is you may not get to the point. So when you start evaluating, all right, if I look at what I have right now, my traditional funds, and it keeps growing and I pull money out at the certain times, is it going to get to the point in my 70s where I'm going to have to pull out more money than I want to and pay more in taxes than I want to at that time? And so that's when you decide, no, my balance is low enough that I could contribute now, and it won't give me high enough required minimum distributions that I'd be concerned about it. So later in your career, you look at your situation, you decide, do I want to or not? I thought that, for instance, I'm getting towards the end of my career. I'm not that close to 65. I got more than a decade before I'm 65, but I'm looking at it, I'm like, maybe I can start doing some traditional now and reduce it from my income. But I forgot to project out from the time I retired until 70s, when I was having to start collecting required minimum distributions. And it's like, no, back to Roth. I can't contribute now because it would grow too much by then. So, and I wouldn't be able to pull out. My plan is not to pull out enough to draw it down. So back to Roth. So I'm growing my Roth again. Anyway, so those are the three accounts. What it does is it gives you the ability to control how much tax you pay. Again, capital gains on your regular brokerage account, you only get taxed when you sell, and you only get taxed on the profit that you make. So if you buy $100 of stock and it goes up to 150, you're only taxed on the 50. You're not taxed on the 100. You can pull all 150 out, but you're only taxed on the 50 when you sell. So you've got taxable, you've got traditional, where you can defer your taxes on that income until later, plus all the growth that happens. And then you've got Roth, where none of that will ever be taxed again, but you are taxed now on the income, and then the growth is never taxed again. And given the growth can be so dramatically high, that's often an extremely good deal. One thing to keep in mind is regular income isn't taxed up to what they call the standard deduction. So there's a 0% tax bracket. They just don't call it that. Anything that's any income you make up to the standard deduction, maybe a little higher depending if you itemize, isn't taxed. So you could, in theory, have all three of these accounts and be pulling from them and have whatever income you want and not pay any taxes. Not any income you want. Any income from those buckets, you can pull it out, and you can choose how much you pull from each, so that you control how much taxes you pay. All could even be down to zero. So you could be living off of $60,000, $70,000, $80,000 a year, no taxes. You just You pull out just enough for the standard deduction from your traditional retirement funds. You pull out enough so that you don't trigger the long-term capital gains above the 0% bracket. And you sell enough that the profit doesn't go above that. So you still get the what you invested is just a profit. So that what you invested in it never gets taxed. It's what doesn't get taxed again. It's the profit that gets taxed. And then the rest of it, you pull it out of your Roth up to what income you want that your Roth will hold. So that's different ways you can control and kind of plan your retirement. And to simplify it dramatically, generally I tell people, look, when you're getting started, if you're young or even middle-aged, just put it in a Roth for now. Get started, get experience in it, and then you can start to decide later how exactly you want to start adjusting things and changing where you're putting money. So anyway, bottom line is there are things to think about. Keep it simple to start. Get started is the most important thing. If you need to if you want to say, hey, I'm interested in investing, but I don't know enough to feel like I can invest, reach out to me. More than happy to walk you through getting you up to speed on enough knowledge that you can feel comfortable investing. If you don't have these accounts, I'd highly recommend you open up a traditional IRA and a Roth IRA. You'll thank me later because there are rules that come into play. And if you have to access these last minute, it can you can be disappointed. So just open up a Roth IRA and a traditional IRA, put like $20 in each and practice. Buy VNQ or VOO or VTI or BND. Buy something in it just to get all right, I've opened an account and I bought something in it. And realize that with traditional IRAs and Roth IRAs, there is a limit to how much you can contribute. Let's put a little bit in to start with just to get the account open and started. But get started, do something, take a small step towards your future. Either get with me and let's go over and get you comfortable with investing, or maybe you determine, no, you've gone over with me and I'm still not comfortable. Well, let's put together a plan for what we're going to do to build your wealth foundation without the stock market. So however you're going to do it, hope you take some action based on what we're talking about today. Take action now, do something towards your future.